Now that we are entering tax season, it is an important time to discuss all of the available tax write-offs for you as a homeowner. But before we get into that, if you're looking for more content about mortgage loans, veterans benefits, buying a home, or being a homeowner, please subscribe to my channel and check out my other videos. There are so many tax write-offs available to homeowners that the average homeowner doesn't even take advantage of. So we're going to hit a few of the high ones today. But as always, when it comes time to make decisions with your taxes, make sure you consult a tax professional or CPA. We're going to start with mortgage interest. And of course, mortgage interest is the charge for borrowing the money to purchase your home. But what a lot of folks don't know is that you can write off that mortgage interest number, at least up to a certain amount, every single year on your taxes. And this is especially important, y'all, in the first 3 to 5 years that you own that home. Because if you remember looking at your amortization schedule, the ratio between interest and principal paid is heavily skewed in favor of interest. So typically speaking, that's going to be a pretty big number that you can write off. And you're going to find this number on a form called a 1098. And it should be provided by your mortgage servicer. Once it's published, typically they'll send it to you in the mail, or if you've elected to get that kind of thing electronically, they should send you an email notifying you to log into your account and download that particular form. But again, if you're a homeowner, you simply cannot forget this one because it's a nice, spicy write-off for you. Next, we're going to go to property taxes. Now, property taxes, there's a few different kinds. I mean, we could be talking about county property taxes. We could be talking about city or municipal taxes, and even taxes related to a school district. You can write all of these off. Now, you can't write off stuff like your HOA or special assessments and, of course, your utilities. But when it comes to those taxes, you can write those off every single year. Now, the IRS does have limits on how much you can claim in any given year. They call it the SALT rule. And the last time I looked it up, it was $10,000 annual. But of course, consult a tax professional or CPA to see what your limit is now. Here's another one, and this one a lot of folks don't know, and that is discount points. That's correct. If you pay discount points as part of your home purchase, you can absolutely write those off on your taxes with a couple caveats. Number one, the discount points had to be paid by you. They can't have been paid by seller incentives or builder incentives or any other kind of third party. The second caveat is the discount points had to be paid as part of a purchase of a primary residence, right? You can't do it if you're buying investment properties, and you can't do it if you're refinancing your home. Sorry, but if you do meet these qualifications, then the discount points you can write off in their entirety, regardless of how much you paid. Next up, home office. If you're one of the thousands of people across the United States, such as myself, that operates your home as a pseudo workplace or center of your business, you can absolutely write off that as well. But like with all things with taxes and the IRS, it's going to come with a few caveats. Number one, the office has to be exclusively used for your business. It can't be a part-time for your business and then a part-time workout room and then a part-time area for your pets. It has to be exclusive usage. It also has to have constant usage. You can't work out of it one time a week and then try to claim it as a home office. And then also it has to be your primary place of business. You cannot write off a home office if you have an office somewhere else in a corporate building or wherever. But if you do meet those criteria, there's a nice list of things that you can write off, to include rent, mortgage interest, utilities, which includes internet, and homeowners insurance. Now, of course, there's limitations and the square footage matters and everything. So when you're writing off a home office, it's pretty complex. You really need to talk to your CPA or tax professional on day one to see how far you can take it without breaking any rules. And the last one we'll cover today is mortgage insurance. So this is mortgage insurance, not homeowners insurance. Now, if you used a FHA loan, then you have mortgage insurance built in to your monthly payment, whether the lender explained it or not. Same deal if you used a conventional loan but didn't put 20% down. Now, that PMI, private mortgage insurance, which is a part of your monthly payment, is actually deductible on your taxes. Now, you're probably going to need to show your CPA, your closing disclosure, or other loan documents, but this number is absolutely deductible and it adds up over the calendar year. Now, these are just a few of the deductions available to you. I highly encourage you, again, talk to a tax professional or do your due diligence on the internet to find out what all you can claim at the end of the year as a homeowner, because it can literally save you thousands and thousands of dollars.